हेलो दोस्तों, बिगनर्स पॉइंट में आपका स्वागत है। और अभी हम कर रहे हैं इकोनॉमी। तो यहाँ से स्टार्ट कर रहे हैं। इससे पहले कर लिया है, नहीं देखा तो प्लेलिस्ट बना रखी है, देख लेना। Circular flow of income and methods of calculating national income. The description of the economy in the previous section enables us to have a rough idea of how a simple economy, without a government, external trade, or any savings, may function. The households receive their payments from the firms for productive activities they perform for the latter. As we have mentioned before, there may fundamentally be four kinds of contributions that can be made during the production of goods and services. Contribution made by human labor, remuneration for which is called wage; contribution made by capital, remuneration for which is called interest; contribution made by entrepreneurship, remuneration of which is profit; contribution made by fixed natural resource called land, remuneration for which is called rent. In this simplified economy, there is only one way in which the households may dispose of their earnings: by spending their entire income of the goods and services produced by the domestic firms. The other channels of disposing their income are closed. We have assumed that the households do not save, they do not pay tax to the government, since there is no government, and neither do they buy imported goods, and since there is no external trade in this simple economy. In other words, factors of production use their remunerations to buy the goods and services which they assisted in producing. The aggregate consumption by the households of the economy is equal to the aggregate expenditure on goods and services produced by the firms in the economy. The entire income of the economy, therefore, comes back to the producers in the form of sales revenue. There is no leakage from the system. There is no difference between the amount that the firm had distributed in the form of factor payments, which is the sum total of remunerations earned by the four factors of production, and the aggregate consumption expenditure that they receive as sales revenue. स्पेंडिंग खर्च करा, ये हाउस होल्ड से, फर्म से आया हाउस होल्ड, गुड सर्विस आया पूरा, फिर यहाँ से दोबारा गया खर्च करा फर्म में, और फैक्टर पेमेंट बना इधर. In the next period of the next in the next period, the firms will once again produce goods and services and pay remunerations to the factor of production. These remunerations will once again be used to buy the goods and services. Hence, year after year, we can imagine the aggregate income of the economy going through the two sectors, firms and households, in a circular way. This is represented in figure 2.1. When the income is being spent on the goods and services produced by the firms, it takes the form of aggregate expenditure received by the firms. Since the value of expenditure must be equal to the value of goods and services, we can equivalently measure the aggregate income by calculating the aggregate value of goods and services produced by the firms. When the aggregate revenue received by the firms is paid out to the factors of production, it takes the form of aggregate income. In figure 2.1, the uppermost arrow going from the households to the firms represents the spending the households undertake to buy goods and services produced by the firms. The second arrow going from the firms to the households is the counterpart of the arrow above. It stands for the goods and services which are following from the firms to the households. In other words, the flow is what the households are getting from the firms for which they are making the expenditure. In short, the two arrows on the top represent the goods and services market. The arrow above represents the flow of payments for the goods and services. The arrow below represents the flow of goods and services. The two arrow at the bottom of the diagram similarly represent the factors of production market. The lowermost arrow going from the households to the firms symbolize the services that the household are rendering to the firms. Using these services, The firms are manufacturing the output. The arrow of this going from the firms to the household represents the payments made by the firms to the households for the service provided by the latter. Since the same amount of money representing the aggregate value of goods and services is moving in a circular way, if we want to estimate the aggregate value of goods and services produced during a year, we can measure the annual value of the flows at any of at the dotted lines indicated in the diagram. We can measure the uppermost flow at point A by measuring the aggregate value of spending that the firms receive for the final goods and services which they produce. This method will be called the expenditure method. If we measure the flow at B by measuring the aggregate value of final goods and services produced by all the firms, it will be called product method. At C, measuring the sum total of all factor payments will be called income method. Observe that the aggregate spending of the economy must be equal to the aggregate income earned by the factors of production. The flows are equal at A and C. Now let us suppose that at a particular period of time, the households decide to spend more on the goods and services produced by the firms for the time being. Let us ignore the question where they would find the money to finance that extra spending since they are already spending all of their income. They may have borrowed the money to finance the additional spending. Now, if they spend more on the goods and services, the firms will produce more goods and services to meet this extra demand. Since they will produce more, the firms must also pay the factors of production extra remunerations. How much extra amount of money will the firms pay? The additional factor payments must be equal to the value of the additional goods and services that are being produced. Thus, the households being will eventually get the extra earnings required to support the initial additional spending that they had undertaken. In other words, the households can decide to spend more, spend beyond their means, and in the end, their income will rise exactly by the amount which is necessary to carry out the extra spending. Putting it differently, an economy may decide to spend more than the present level of income. But by doing so, its income will eventually rise to a level consistent with the higher spending level. This may seem a little paradoxical at first, but since income is moving in a circular fashion, it is not difficult to figure out that a rise in the flow at one point must eventually lead to a rise in the flow or at all levels. This is one more example of how the functioning of a single economic agent, say a household, may differ from the functioning of the economy as whole. In the former, the spending gets restricted by the individual income of a household. It can never happen that a single worker decides to spend more and this leads to an equivalent rise in her income. We shall spend more time on how higher aggregate spending leads to change in aggregate income in later chapter. The above mentioned sketchy illustrations of an economy is admittedly a simplified one. Such a story which describes the functioning of an imaginary economy is called macroeconomic model. It is clear that a model does not describe an actual economy in detail. For example, our model assumes that households do not save, there is no government, no trade with other countries. However, models do not want to capture an economy in its every minute detail. Their purpose is to highlight some essential features of the functioning of an economic system, but one has to be cautious not to simplify the name matters in such a way that misrepresents the essential nature of the economy. The subject of economics is full of models, many of which will be presented in this book. One task of an economist is the is to figure out which model is applicable to which real situation. If we change our simple model described of the introduced savings, will it change the principal conclusion that the aggregate estimate of the income of the economy will remain the same whether we decide to calculate it A, B, or C. It turns out that this conclusion does not change in a fundamental way, no matter how complicated an economic system may be. The annual production of goods and services estimated through the each of the three methods is the same. We have seen that the aggregate value of goods and services produced in an economy can be calculated by three methods. We now discuss the detailed steps of these calculations. अब आ जाते हैं द प्रोडक्ट और वैल्यू एडेड मेथड. In product method, we calculate the aggregate annual value of goods and services produced. If a year the unit of time, how to go about doing this? Do we add up the value of goods and services produced by all the firms in an economy? The following example will help us understand. Let us suppose that there are only two kinds of producers in the economy. They are the wheat producers or the farmers, and the bread makers, the bakers. The wheat producers grow wheat and they do not need any input other than human labor. They sell a part of the wheat to the bakers. The bakers do not need any other raw materials besides wheat to produce bread. Let us suppose that in a year, the total value of wheat that the farmers have produced is rupees 100. Out of this, they have sold 50 rupees worth of wheat to the bakers. The bakers have used this amount of wheat completely during the year and have produced rupees 200 worth of bread. What is the value of total production in the economy? If we follow the simple way of aggregating the values of production of the sectors, we would add rupees 200 value of production of bakers to rupees 100 value of production of farmers. The result will be 300. A little reflection will tell us that the value of aggregate production is not rupees 300. The farmers had produced rupees 100 worth of wheat for which it did not need assistance of any input. Therefore, the entire rupees 100 is rightfully the contribution of the farmers. But the same is not true for the bakers. The bakers had to buy rupees 50 worth of wheat to produce their bread. The rupees 200 worth of bread that they have produced is not entirely their own contribution. To calculate the net contribution of bakers, we need to subtract the value of the wheat that they have bought from the farmers. If we do not do this well, this we shall commit the mistake of double counting. This is because rupees 50 worth of wheat will be counted twice. First, it will be counted as a part of the output produced by the farmers. Second time, it will be counted as the imputed value of wheat in the bread produced by the bakers. Therefore, the net contribution made by the bakers is rupees 200 to 50 150. Hence, aggregate value of goods produced by this simple economy is rupees 100. Net contribution by the farmers rupees 150. Net contribution by the bakers 250. The term that is used to denote the net contribution made by a firm is called its value added. We have seen that the raw materials that a firm buys from another firm, which are completely used up in the process of production, are called intermediate goods. Therefore, the value added of a firm is value of production of the firm, value of intermediate goods used by the firm. The value added of a firm is distributed among its four factors of production, namely labor, capital, entrepreneurship, and land. Therefore, wages, interest, profits, and rents paid out by the firm must add up to the value added of the firm. Value added is a flow variable. We can represent the example given above in terms of 2.1. Total production farmer 100, baker 200, intermediate goods used 0, 50, value added 100, 200 minus 50, 150. Here all the variables are expressed in terms of money. We can think of the market prices of the goods being used to evaluate the different variables listed here, and we can introduce more players in the chain of production in the example and make it more realistic and complicated. For example, the farmer may be using fertilizers or pesticides to produce wheat. The value of these inputs will have to be deducted from the value of output of wheat, or the bakers may be selling the bread to a restaurant whose value added will have to be calculated by subtracting the value of intermediate goods bread in this case. We have already introduced the concept of depreciation, which is also known as consumption of fixed capital. Since the capital which is used to carry out production undergoes wear and tears, the producer has to undertake replacement investments to keep the value of capital constant. The replacement investment is same as depreciation of capital. If we include depreciation in value added, then the measure of value added that we obtain is called gross value added. If we deduct the value of depreciation from gross value added, we obtain net value added. Unlike gross value added, net value added does not include wear and tear that capital has undergone. For example, let us say a firm produces 100 rupee worth goods per year. 20 rupees in the value is the value of intermediate goods used by it during the year, and 10 rupees is value of capital consumption. The gross value added to the of the firm will be rupees 100 minus 20 equals to 80 per year. The net value added will be 100 minus 20 minus 10 equals to 70 per year. It is to be noted that while calculating the value added, we are taking the value of production of firms, but a firm may be unable to sell of its produce. In such a case, it will have some unsold stock at the end of the year. Conversely, it may so happen that a firm had some initial unsold stock to begin with. During the year that follows, it has produced very little, but it has met the demand in the market by selling from the stock it had at the beginning of the year. How shall we treat these stocks which a firm may intentionally or unintentionally carry with itself? Also, let us remember that a firm buys raw materials from other firms. The part of raw materials which gets used up in is categorized as an intermediate good. What happens to the part which does not get used up? In economics, the stock of unsold finished goods or semi-finished goods or raw materials which a firm carries from one year to the next is called inventory. Inventory is a stock variable. It may have a value at the beginning of the year. It may have a higher value at the end of the year. In such a case, inventories have increased or accumulated. If the value of inventories is less at the end of the year compared to the beginning of the year, inventories have decreased, decumulated. We can therefore infer that the change of inventories of a firm during a year, production of the firm during the year minus sale of the firm during the year. The sign stands for identity, unlike equality, equal to, and identity always hold, irrespective of what variables we have on the left hand and right hand sides of it. For example, we can write 2 plus 2 equals to 4, identity equals to 4, because this is always true, but we must write 2 into x equals to 4. This is because 2 times x equal to 4 for particular value of x, namely x is equal to when. Not always. We cannot write 2 into x identity 4, जो एकदम सत्य है, प्रमाणित है, एकदम ट्रू है, हमेशा वही रहेगा, चेंज नहीं होगा। उसके लिए हम जो साइन का यूज़ करते हैं वो होता है ऐसे आइडेंटिटी का, और इक्वलिटी का होता है कि बदल सकता है। Observe that since production of the firm value added plus intermediate goods used by the firm, we get change of inventories of a firm during a year, identity value added plus intermediate goods used by the firm minus sale of the firm during a year. For example, let us suppose that a firm had an unsold stock worth of rupees 100 at beginning of the year. During the year, it had produced rupees 1000 worth of goods and managed to sell rupees 800 worth of goods. Therefore, the rupees 200 is the difference between production and sales. This rupees 200 worth of goods is the change in inventories. This will add to the rupees 100 worth of inventories the firm started with. Hence, the inventories at the end of the year is rupees 100 plus 200 equals to 300. Notice that change in inventories takes place over a period of time, therefore, it is a flow variable. Inventories are treated as capital. Addition to the stock of capital of a firm is known as investment. Therefore, a change in the inventory of a firm is treated as investment. There can be three major categories of investment. First is the rise in the value of inventories of a firm over a year, which is treated as investment expenditure undertaken by the firm. The second category of investment is the fixed business investment, which is defined as the addition to the machinery, factory buildings, and equipment employed by the firms. The last category of investment is the residential investment, which refers to the addition of housing facilities. Change in inventories may be planned or unplanned. In case of unexpected fall in sales, the firm will have unsold stock of goods which is had not anticipated. Hence, there will be unplanned accumulation of inventories. In the opposite case, where there is unexpected rise in the sales, there will be unplanned decumulation of inventories. अब यहाँ से पढ़ेंगे अब